Good morning, good afternoon, and good evening. It's 3:24 p.m., March 3, 2023, Friday. I hope everyone's having a good week. How are you doing, Wabi?
Doing good, Mark. How are you? I'm just a little sniffly today.
A little bit under the weather?
Seasonal allergies, most likely.
Oh yeah, yeah. This morning I remember when I woke up it was pretty cold. I think it's well, not cold in other compared to other areas, but here in South Texas we were at mid 50s, so that's pretty cold.
Yeah, yeah. We are at the high 40s this morning.
Oh, they're in East Texas, so it's definitely a little bit colder, obviously. For those listeners who are just joining us, this is Mark Q and Wowie Show, and welcome to our latest episode, episode 70, Further Outflows. So, me and Wowie are both physical therapists here in Texas. We record once a week, or try to at least, as we take a look at recent market trends and fundamentals, news behind what's happening, where's the money going in the stock market. So we are at episode 70. That's it's been a while, quite a
Wow.
journey for the past,
Yes,
past couple
seven
of years.
zero.
Yeah. When we first started, I remember me and Wowie were urging everybody, and even until now, to try to at least open a brokerage account and start investing their hard earned money in the stock market. That way they could benefit over the long term with its returns. Little did we know that back when we started back in 2021, the stock market was just, always almost every other day or every day been going up. And then in 2022, everything fell, including not just stocks, but also bonds and whatever. So it's been quite a rocky journey for the past couple of years, but here we are, still
Mm-hmm.
standing tall, still buying our own
Still
stock
resilient
returns, still
and
resilient.
and still thriving.
Yes, sir. Still thriving, doing our research and which where to put the money. So as we take a look on a weekly basis, the sentiments in the stock market, if everybody thinks or most people think the stock market will be up or down, this is the widely known investor sentiment survey, the American Association of Individual Investors, done once a week. So as of March 1st, beginning of the month, investors are a little bit more bullish on a 23.4% compared to 21.6 last week, but more of the bearish as well, 44.8% compared to 38.6. And if you're going to look at the data here, this is the most bearish or fearful the individual investors are in the past 4 weeks. And if we're going to take a look at the fear and greed index, okay, now we have pulled back quite a bit. Now we're at neutral compared to where we were a week ago and over a month ago. We were over at least in the greed territory. We're now at neutral. Market momentum wise, as some of you may have observed, Thursday and Friday, including today, Thursday yesterday, the market has bounced back pretty strong for some reason. Um, the S&P jumped from 3,950 back up to 4,043. So we're above 4,000 mark again. We barely touch the 125-day moving average, which is, in my opinion, is a solid indicator of momentum. If we breach this 4-month average downwards, then usually there's a strong sentiment that the stock market would keep on going down, like what happened recently back in mid-December when it breached down the level, and it lasted there for almost a month until January 9th. And then a sudden blip on January 19th actually, but we pushed through. We went up again, breached through it on the upside, and we've been up since January 19 until present. So it's been quite a while. January 19, February 19, that's 1 month, and now it's March 3rd. So 20 more days after that. So about a
Yeah.
month and almost 2 months, right, Wawi?
Yes, and I'm surprised to see that the mini futures are up. I've never seen Nasdaq mini futures being up at 2%, and
Really?
the Dow, yes.
Wow.
So people are bucking the trend
Hmm.
of the rate hikes. These
People
retail
are,
investors
yep,
are are buying.
they're getting bullish for some reason.
Mhm.
And if we're going to tackle in a little bit a couple of statements from the former uh, Treasury, uh, Larry Summers, actually pushing for higher rate hikes down the road because he's saying that the Federal Reserve is again behind inflation. They're just reacting to it and not being proactive to control it. The volatility index, meanwhile, for the day it's down 5.6%. For the past 5 days, we're actually down nearly 14%. So not much. If we're just gonna take a look at this number alone, and it's what happened the past 5 days, one would think that the stock market has been rallying. But actually, let's see. The S&P 500 for the past 5 days is up 1.3%, including what just happened from Thursday to today. It's up 2.5%, plus 100 points upside. So that's quite a bullish comeback there. Will this be
Yeah.
just a blip?
Well, it looks like a blip right now for
Hmm.
this day's recovery and rally.
Right.
Um, Looking at the performance of my portfolio, I'm just happy to see that is doing good today.
Right. It's always a pleasant sight to see green in the portfolio, right?
Yes, it was all green on all the indices today.
Yeah. So the volatility for the Nasdaq, which is tech heavy, which includes your Amazon, Google, Facebook, Netflix, all the rest, the volatility on that end was down also as well for 10% in the past 5 days. And the Nasdaq index, it's up 1.49%, a rally since Thursday morning. So that's interesting.
Yeah, it broke its 4 week slowdown.
Mm-hmm. And we're gonna be in for a little surprise once we look at the fund flows for sure, Huawei. So
Hmm.
for the past week, as we get to the fund flow section after this, for the past week, the best performing sector is basic materials, followed by communication services, in industrials, and then technology. Energy is also clinging into technology. So it's almost each and every sector actually experienced a little bit of rally, except for consumer defensive and utilities. Healthcare barely breached the 1% mark, 1% positive, but still on the green. So looks like the three sectors that you would be putting your money when you fear recession are the worst performing sectors for the past 5 days. Does this show any type of promise that there'll be a turnaround coming soon? Or is this again a false come on for the market to attract more investors and then later on sucker punch them and rug pull them? That's like what happened to us in 2022.
Well, there's gonna be a lot of head fakes for sure this coming season.
Yeah. Now
It's gonna
we're
stay volatile.
now we're in March, so almost first quarter this year is almost done that quick. Time flies for sure. Year to date, look at that, Huawei. Technology is still the best performing sector at 13.6% or nearly 14%, followed by consumer cyclicals. The worst performing sector, if I'm gonna highlight here, utilities, healthcare, and consumer defensive. So, by the looks of it, investors since the start of the year have still punished the industries that should be protecting them should there be a recession. Now that a lot of experts are saying we should be in one soon. So here we go. This is the latest upload from Reuters. Where is the money going? This is updated 9 hours ago. This says global equity funds see biggest weekly outflow in 2 months. So this is again another almost similar title from last week, right, Wawi?
Mm-hmm. And it may have something to do with, China and U.S. trade tensions.
Yep. So
It,
investors are still bailing out. They're selling their stock market investments. And this is since the start of the year, 2 months, and we just barely started March. Today is March 3. So global equity funds suffered their biggest weekly net selling after strong US economic data stoked fears about further rises in interest rates. So nothing else is more strong and scaring investors except for the Federal Reserve. So according to the President, Federal Reserve of Atlanta, Raphael Bostic, he favored slow and steady quarter point US rate increases to limit risk in the economy. So this guy is a little bit more of the dovish uh, Federal Reserve governors out there. This is because since he said those words, most of the stocks recovered some of our underperformance today.
Mhm. Yeah, it's a wonder how, Jay Powell and these governors of the Federal Reserve can like have that meme effect
Right.
on retail investors.
Huge. Yeah, they when they start giving their statements, the market moves by the billions and hundreds of billions of dollars. So for the US and Europe, both countries saw a lot of outflows, particularly the United States, almost $13 billion worth of stock selling, and then 660 million worth came out from Europe. Meanwhile, Asia received inflows of $1.35 billion. So healthcare, tech, and utilities, they all experience outflows. Healthcare experienced 1.1 billion in outflow. The tech, half a billion outflows, and utilities, 450 million in outflow. So low risk money market funds, people are putting some of that money, 51 billion on the low risk money market funds, the most since January 4th. So that's interesting. People are parking their money there. And also global bond funds accumulated 6.8 billion in inflows. So people are diving into bonds and money market at this point of time. Commodity also lost 1.3 billion in outflows. So people are getting a little bit more defensive here. People are still bearish, are more bearish right now. They pretty much sure missed the rally for the past couple of days if you have sold. But yeah, so the year-to-date performance, this is what we're gonna add on our weekly review on occasion. So year-to-date, the best performing index is the Euro Stocks 50, followed by Nasdaq. I can't believe it, but I'm saying it. Nasdaq is the second best performing index in the world, 11.8%. Oh, wow. Audio, we're having a little bit of audio.
Oh, I was
There
just
you go.
saying, it's it probably all happened just in January and
Uh-huh.
today.
True, true. Yeah, because February was quite a sell-off.
Mm-hmm.
So until now, Nasdaq is holding on to that gains. You're right, Wawi. I just realized that. It's been all in January that the recovery happened. The
Mm-hmm.
gasoline is still up. Look at that. Speaking about inflation, 10.98. Orange juice, about the same as gasoline. Russell, small capitalization stocks. Nikkei, which is Japan. Copper is still up 6.9%. Coffee, cocoa, lumber is actually up.
Ooh.
S&P, okay, live cattle, sugar. Worst performing is natural gas. So watch out for those oil companies that only does natural gas businesses. I haven't really looked into it, but if anything, I could remember it's LNG, one of the biggest Cheniere,
Mm-hmm.
natural gas companies out there. It's a $40 billion worth company. But look at that. Even itself, it's up nearly 17% despite
Woo!
natural gas falling. So that's
Wow.
quite an interesting find right there. The volatility is down nearly 16%. Palladium, I think palladium is the one being used in batteries. Is that right? Or some sort of
Oh, I have no
ingredient
idea.
in electric cars?
It could be. Let's see.
What is its purpose? Electric vehicles do not need palladium. What does palladium do? Palladium was.
Catalytic converter. So it's a, for making catalytic converters for ICE cars,
Oh,
and also used in jewelry and dental fillings and crowns.
I see, I see.
Hmm. Learned something new today.
Right. And it says here,
Palladium.
not all electrical vehicles need palladium. So it's not that common. I guess it was hyped up some point last year. Now it's giving all those gains back. So this is just a highlight that we would like to include in this podcast, in this episode. The federal funds rate. So this is what the Federal Reserve is looking at. So as of today, or as of yesterday, the rate is 4.57%. So that's quite an elevation, 4.57. Well, honestly, since January, since the start of the year, it was hovering around 4.36. Now it's 4. And if we're gonna look at its chart, which is more helpful, so since the Federal Reserve started to hike its rates, we have been seeing a lot of punishment in the stock market overall.
Mhm.
So they began back in March of 2022. We were just around 0.08 back then. 0.08, and now we're at 4.57. So that's how far, the steep of a climb that we had done in
Yes.
such a short period of time.
One of the
Whereas,
fastest on record.
yes, whereas back in June 2004 to July 2006, the effective funds rate was from 1% to 5.26. 5.26, doing a little bit of math. That was a climb of 4.26. But now, from 0.08, now we're at 4.58. That's a climb of 4.5%. So let me see.
Well, they're saying this time it may be different if it took them 2 years from 2006 to 2008 to recover
Yeah,
back to a lower easing
you
type of rate. This may be longer because of the amount of liquidity that's still out there. Even considering the increasing amount of debt that's going on, there's still trillions of dollars that is flowing there in
yeah,
the market.
yeah, compared to over a decade ago when we were in the housing crisis or prior to that. So, but still, we would just like to emphasize the high, steep climb here, and followed that with the CNBC data right now. So, if we're gonna take a look at the 6-month Treasury, this is risk-free. If you believe in the U.S. making its payments, debt payments year in and year out, the United States has never defaulted on their loans. So this is can be considered as good as secure or the
Mm-hmm.
safest investments out there. The 6-month treasury, if you park your money there doing nothing for a year, it would give you 5.13%. Six
And if
months.
they increase their debt ceiling come mid-year, July or June, expect an increase in these yields on the short-term treasury, especially.
Mhm.
It may respond to that increase in debt ceiling.
All right. Give me just a second here while
We're having a little technical difficulty, or Mark is probably checking on his dogs right now. Anyway, for the group, um our coach, Coach Stephen Pamatmat, just attended and spoke at the WCI convention. So uh, he shared with us what he learned there, and uh, he he gave us some ideas, using Paul Merriman's method. In the 3 years that I've been investing, I didn't know I was doing something similar until now. Anyway, I'll be sharing my book recommendation based on Coach Stephen's WCI conference insights.
Thank you. Sorry about that, Wawi. Now that there's an unexpected phone call from a clinic. So here we are at looking at some chart. This is from Charles Schwab Research, the AAII investor sentiment. So looks like the bears are obviously getting back at it. Now they're spiking back up, not seen since early 2022 during the sell-off. And bearish reading has slowly been climbing up as well. So what I'm trying to see is like, I guess the couple of days, including today's rally, hasn't been that much expected because a lot of people are still on the bearish side of things or thinking that the stock market would go down. So here's the probability of the Fed hike 50 basis points on March 22nd. The probability is climbing and climbing up since the start of the year.
Ooh,
Initially it was
30%.
0%, now we're close to 30%. That the Federal Reserve would hike 50 basis points again. Because I think recently we hiked to 25 basis, right, Wawi?
Yes, yes. And I think some people are just banking that, they're just going to go with the 25 basis points, but it's not very likely looking
Mhm.
at the data.
Right. And none other than the former Treasury Secretary also backing this call. He's urging Jerome Powell to open the door to 50 basis point this month. So the more that the people expects a 50 basis point, I think the better the market reception will be. But if a lot of people goes sideways and says that it's too much already, then I guess that's when the trouble or the sell-off could happen in the stock market.
And that's why I'm working hard to save some dry powder just in case that happens.
Right.
So,
Always having some cash aside ready to buy. It's always important if you have a portfolio, especially for the long term. So I think there's a quote here from Larry Summers. He says, "I've been very disappointed to see some of the speeches coming out of the Fed that have seemed to leave March off the table as a possible place for 50. I hope the senior leadership of the Fed will guide to agnosticism on the possibility of a 50 basis point move in March." So
so
he's making
definitely there the media is always seeking, these governors to say something, especially the chairman, Jay Powell.
right. Oh well,
They're
we'll see.
they're hanging on their words.
Yep. And inflation is still definitely out there. Meanwhile, corporates, big companies here in the US have been firing a lot of workers. And at the same time, now one of the biggest ones, Amazon, has been announcing that they'll be uh, halting or pausing their second headquarters. in the coming months. So this is not the first one I think that I read from Amazon today, but here we go. According to the Financial Times article, it says Amazon pauses construction on its second headquarters in Virginia. So
Definitely reducing their capital expenditures at this time. They would be affected by the, you know, the high rates because they are a global company.
mhm. And not just that, if there's another news as well that Amazon is closing its cashier-less stores in New York, San Francisco, and Seattle.
Yeah,
So,
that experiment probably has failed.
uh-huh. I think I only saw saw those stores on YouTube where they just show their app and it will have the specific code to scan and you can go inside the store and start getting all the things that you need, put them on your card and not worry about paying anything. You can just, go through the cashier and expect a charge on your Visa or whichever that's connected to your Amazon account. So they're done with experimenting on that side. And if we're just gonna take a look at Amazon's recent numbers that was published on February 2nd, let's see how they're doing with their free cash flow. So free cash flow is operating activities, cash flows from that minus the capital expenditures. So this is what Warren Buffett also likes to take a look at companies if they're able to generate free cash. So in 2022, Amazon generated $46.75 billion. And they spent about $63.6 billion.
Oh, that's still a huge chunk of money still left over.
Yeah. No, I mean the operating from cash flow from operations is just 46 billion. So they generated actually negative free cash flow. They had
Oh,
they had to pile in a lot of debt, $41.5 billion in debt to generate, well, not just that, that's short term, 41.55 plus 21.16 billion. So 62 billion dollars in debt minus a little bit of repayments here and there to generate a little bit of cash left, 9.7 billion. So yeah, they need to start saving for sure. Now that investors are critiquing every little bit of expenditure that the company is reporting. All right, so it says here we got 10 minutes left while we gotta rush. We would like to just take a look at the FANG companies here, valuations so far. Let's see if we could run this through and also take a look at their profit margin since they just reported. So for the profit margins, it's always nice to see if it's trending up. It means that the company is generating more profits. So the red one definitely is making a good progress for the past 6-7 years since 2017. That's Microsoft. Microsoft is actually the most profitable among the FANG stocks. Its profit margin is 34.6. Next one would be the one in purple, which is Apple at 25.4. It's been slowly trending up, followed by green, Google. Google is actually slumping. It used to be the second most profitable among the group. Now it's the third. And then followed by Facebook. Facebook has been slumping down. About 6-7 years ago, nothing, not one company in the FANG stocks can beat Facebook in terms of its profitability. But I guess it reached its peak back in late 2016. Now it's just the fourth most profitable company, probably because of its goggle
metaverse.
metaverse.
The goggles. Well, they actually said that they're gonna lower the prices on their AI, AR,
Hmm.
VR goggles,
You know
so
what I
they can
found?
capture that market.
Yeah, you know what I found out? There's a really good competitor for Meta's platform. It's called Pico 4. It's pro
Oh,
it's built or made by a Chinese company. It's not available in the US, but it looks very nice. Like if you go to Pico XR, its front-facing goggle looks pretty decent, and it looks like it's pretty light. We're looking at it right now in our podcast recording.
wow.
It's pretty
Sweet.
decent, right?
Yeah.
Pretty sleek. So it's not available in the US market because it primarily, it's made in China and it's a competitor of Facebook.
Mm-hmm.
But yeah, it looks like it'll be a tough competitor for Facebook. Next most profitable one after Facebook, we're down to two, is Netflix. But look at that, Netflix has been more profitable each and every year. Who knows? It might overlap, it may overtake Facebook 2, 3 years from now.
Amazing.
And then
Amazing.
still at the bottom, none other than Amazon, 2.9% profitability. So before we end the show, we're just gonna take a look at one of the biggest companies out there that just came out with their report, Costco.
Costco.
Costco warehouse, market cap $215.5 billion. It came out with this earnings last night, March 2nd, 4:22 p.m. It beats its earnings expectations, but it missed its revenue estimates by 340 million.
Yeah, it
Comparable
was
sales.
it was punished, right?
Yeah, I think today it's down maybe a 1% or no, 2.15%. Not so bad.
Mhm.
Still hanging in
Yes.
there. And just a quick run through of its numbers. All right, here we go. Revenue for because this is what? Second quarter, so 6 months operation. 6 months. Oh yeah, 24 weeks. 4 months of operations. So its sales went up by nearly 7.5 billion dollars. And then its income, not bad. It went up by about 200 million from 2.66 to 2.83. Pretty solid there. Cash in Costco's balance sheet as of February is $12.97 billion, while its debt is around 6.5 plus 2.4, about 10, roughly $11 billion. Pretty much solid company here overall.
It
Book
should
value,
shoot back up again by
yeah,
next week.
book value is about 22 billion. Yeah, not bad. Its
Hmm.
valuation, if we're gonna take a look, I'm not so sure. We can put it up here. Forward earnings. Honestly, there's a disclosure. I also have Costco. You have Costco as well, Huawei?
No, I was just looking at it today after it went down. So a lot of people have been buying it today. No, I don't have Costco nor HD Home Depot. I should.
Yeah, Costco's forward price to earnings is 33 times, still quite expensive compared to its median industry, which is almost 20 times. But Costco has its own premium. It carries its own premium. I could vouch for it because I'm also a Costco member and I benefit from being a member in this company and its warehouses. Alrighty,
Guess it.
Huawei. Mhm.
All right, we got a few more minutes.
Yes, sir. We still got a
Uh,
few if you want to share something.
yeah. So if you just pull up that thing I sent you on Messenger, is about
Mhm.
Paul Merriman's book. It was shared by my coach, my investment coach, Coach Stephen Pamatmat of
Mhm.
White Coat Investor. So I want to share that with our viewers and listeners.
This one.
Please check out the book by Paul Merriman and Richard Buck. We're talking millions. 12 simple ways to supercharge your retirement. It's an interesting book. And like I was saying a while ago, I didn't know I was kind of doing the same thing because when I started investing in 2018 actively, uh, the S&P 500 index was just too slow for me. So I decided to diversify in stocks. So read the book. I think it's worth it, especially if you're between 20 and 30 years of age.
12 simple ways supercharge. I guess if somewhere here in Google they could outline it, but I guess I won't be able to. Well, what's one thing that you would like to if you have you read it already?
Yeah, so basically you diversify by, buying large cap, mid cap, small cap, and different equities. And then if you're not such a risk taker, then add a few bonds to your allocation.
Oh, there we go.
Yeah.
We got 1 to 12 here from their website. Keep your expenses low, definitely.
Mm-hmm.
Here we go,
And
Wawi. Don't try to time the market or outwit it.
you can't.
Yep,
Just
that's
like
for
today
sure.
is an example of it.
Yeah, I know. People are still pulling out outflows after week after week after week, and this headlines gets tiring again. I mean, I thought we were over with 2022, but this is what we have been
Mhm.
experiencing for the whole year of last year. So,
Yeah. But don't get the investment fatigue. Just keep dollar cost averaging. It's good. It's a good strategy.
yep. Well, I thank you for sharing that book, We're Talking Millions from Paul Merriman and Richard Buck.
You're
And guys,
welcome.
if you're still around, please hit the like and subscribe button. We appreciate it.
Like and
Mhm.
subscribe.
And thank you guys again for joining us for another week of interesting discussion, a review of Wall Street events. Again, this is Mark Yu signing out.
Wawi Santos signing out with a sniffle.